Thank you everyone for joining us today for our Q2 Manufacturing Outlook webinar. We are delighted today to be joined by Make UK's Director of Industrial Sectors, Technology and Innovation, Tim Figgers, who will be providing an update on the state of UK manufacturing and sharing the findings from our latest Manufacturing Outlook report. This quarter, we are also joined by Tim Foster, a partner in BDO's Risk and Advisory Services team. Tim will be sharing practical insights into the impact of COVID-19 on manufacturer supply chains and, more importantly, what manufacturers should be thinking about for the future.
So firstly, on to our Manufacturing Outlook. Now, this Q2 report in partnership with BDO, it's the second one since the UK formally left the EU at the start of the year. But more importantly, it's the first one where we've included a comprehensive overview of the impact of COVID-19. And our previous edition, the Q1 2020, reported some emerging weaknesses across the manufacturing sector, even before the COVID-19 crisis had begun. But it did show at the time that UK manufacturers were feeling pretty positive about the future, and perhaps following the general election and some certainty about the direction of travel of the Brexit process, were gearing up to commit to capital investments in long-term projects. Now, throughout 2019, when we had these various Brexit deadlines which came and went, the economic cycle was, perhaps we might say, pockmarked, with episodes of last-minute safety stockpiling in anticipation of each EU exit deadline, as well as hasty attempts to clear out warehouses when each no-deal deadline was averted. However, manufacturers told us in Q1, before the current crisis hit, that they were now looking forward to returning to a period of cyclical normality, and that they were starting to turn on the taps and feeling more confident about investing. Unfortunately, the results that we're going to share with you today do make clear that those expectations have been very swiftly undone by the unexpected COVID-19 pandemic. And that means that confidence in the business and the economic environment is down sharply again. In particular, as a result of the crisis, our latest survey shows the most negative output balance since our survey records began, which is nearly 30 years ago. I'll just say that again, the most negative output balance since our survey records began almost 30 years ago. Both domestic and export demand have declined to levels which are comparable to the worst of the global financial crisis, but have done so in half the time. So that's the same impact of the 2008 financial crisis, but we've reached it twice as quickly as that crisis took to hold. All subsectors within UK manufacturing have seen shrinking order books, and prices and margins have tightened significantly, and cash flow is being squeezed. Confidence inevitably has collapsed, and just as we thought investment taps were about to be turned on, now companies, not surprisingly, are very much holding back on investment. And even with the government's furlough scheme, redundancies are increasing. Most firms expect further falls in output before a slow and weak recovery begins. So here you can see the particular indications across the period, and you can see there the point that I was making, clearly illustrated to the right-hand side, that 2020 Q2's numbers, both in terms of output and orders, are of a negative value, broadly speaking, equivalent to that of the global financial crisis, which we've just put in a kind of light shade towards the right-hand side of that. I think what you can see here is our output balance at minus 56% is the worst ever on record in the 30 years of us doing these things. And manufacturers' expectations for recovery are equally alarming. Make UK members predict that their output balance will be minus 42% over the next 3 months. And that's the worst score that they've ever predicted in this quarterly survey. And the total order balance, as you can see here, has also declined to minus 53% this quarter. That's its lowest level ever once again. Our previous study in the last quarter reported a negative balance for domestic orders for the third consecutive quarter. But before the current crisis, domestic orders were at least trending in an upwards direction. Now, the COVID-19 crisis has undone that. Unfortunately, you can see with the blue line the very sharp reduction in one single quarter. And once again, expectations are weak. For the next 3 months, they're at minus 41% on balance for total orders. And what this really means is that the export demand for UK-made goods, which was in decline even before the coronavirus epidemic hit our shores, has continued. There may be a number of factors behind that the impending erection of trade barriers with our largest trading partner, the European Union, in about 6 months' time, may well have quite a lot to do with that. But other things that this crisis has exposed, particularly around the vulnerability of supply chains, which UK manufacturers sit in the middle of, has also made exporting harder. And unfortunately, this wasn't just concentrated in one part of the manufacturing sector. It has been seen across all of the subsectors that we look at. Basic metals wasn't quite as bad as the others, but others, particularly mechanical equipment and electrical equipment, have seen very, very, very significant reductions in orders. And what we're also seeing is that demand from key markets has weakened. The blue bars are Asia, the orange bars are Europe, and the blue bars are North America. Slight blip in rubber and plastics for this one, but we've been tracking across all of our subsectors demand reductions in these key submarkets. The EU does remain, as I said a minute ago, our most important foreign market, and our members say that irrespective of the outcome of Brexit trade negotiations, that is likely to be the case because of size, because of proximity, and because of our historical integration with it. And I'm afraid, looking into the future, we see that manufacturers expect further falls. Around a third of manufacturers have told us that their orders have declined by up to 50%. And just looking at the Office of Budget Responsibility analysis, they say that manufacturing, construction, retail, travel, food processing, and the education sector, obviously not all manufacturing there, will see the biggest losses. And this in manufacturing is despite our sector not being ordered to close by the government. Again, our survey data says that 95% of UK manufacturers have remained operational, but they've had to reduce activity, largely because of a massive reduction in demand, but sometimes because of interruptions to key components or raw materials as international supply chains have become disrupted. It's also important to note that social distancing restrictions have continued to disrupt, but they've disrupted the services sector more than the manufacturing sector. Manufacturers have managed to keep operating in a socially distanced way. And actually that means that the UK is probably more reliant now on manufacturers rather than services to lead the recovery. Different parts of the economy, though, will recover at different speeds. And our biggest export market, the EU, has said it could be 2024 before its economy fully recovers from the economic and trade effects of the COVID-19 crisis. And the Chancellor, Rishi Sunak, has made similar forecasts for the UK. We've also seen significant worsening in export margins. As repeated in our previous quarterly statistics, margins were trending down in Q1 2020 anyway, even before the latest pandemic. But this also shows that UK prices have declined to -2%. That's the first negative result since the aftermath of the EU referendum in Q3 2016. Export prices, however, remain marginally positive at 3%. Low domestic selling prices suggest that manufacturers are desperately trying to sell existing stock at significant discounts, but that means they're going to be relatively small opportunities for profit. And because many export markets are also caught in lockdowns where they are, that makes it increasingly difficult for firms to attract orders from international markets. So not surprisingly, given this difficult context, manufacturers expect prices and margins to fall further over the next 3 months. And just going quickly through the next set of slides, not surprisingly, confidence has also fallen sharply. You can see there very clearly the uptick towards the end of last year following the general election, and confidence has now fallen to levels that were only last seen in 2019, when it looked as though we were facing a no-deal Brexit. Despite the coronavirus job retention scheme, the furlough scheme, we're also seeing corresponding reductions in employment. And as that scheme starts to wind down progressively over the next few months, we'll expect to see significant increases in redundancies coming through. As I said at the beginning, not surprisingly, again, that peak of confidence you saw just around the end of the year following the general election has been undone. And actually, investment plans are lower now than they were around the Brexit referendum and the uncertainty that caused. Now, I'd just like to spend a minute or two before passing on to the next speaker about some regional analysis. We've done this for the first time and looked at how the impact of COVID-19 is affecting manufacturers in different parts of the country. So you can see there quite a significant differential on these statistics depending on where you are in the country. Now, the figures look bad wherever they may be. I would offer a bit of a health warning for those northeast statistics. That might be because we had a relatively small number of respondents to our survey from that region. So it is not a question of good versus bad, it's a question of bad versus very bad. But if you look at that map, that indicates the parts of the country that have been particularly affected. So the redder the region, the more our members have reported compound impacts from COVID. And so just finally, before I leave you, this is our forecast for 2020. We are now forecasting an end year position of -10%, and then weak growth of 5.8% in 2021. So only half of the negative impact of the current crisis will have been recovered by the end of next year. So just to recap, output's fallen to the lowest level on record, and that's undone the boost in confidence we had around about the turn of the year. It'll take a very considerable time to recover, way beyond the end of 2021. And as you can see, while all of the country has been affected, northern regions, more manufacturing-dependent regions, have been more affected than more service-dependent regions. So I'll just end there and pass you back to the host.
So I've been asked to pick up and talk around what businesses are doing to manage their supply chain risk. As a risk advisory services partner for BDO, I work with a whole range of clients from small entrepreneurial businesses to mid-sized manufacturers to large corporates. So we're seeing a real mix of different challenges across different sectors with regards to supply chain. So I thought I'd play back some of the things that we're seeing and how various clients and organizations that we're working with are addressing the key issues that they're currently facing around their supply chain. So one of the things that we've done as a firm is obviously the pace of change very, very quickly became very high. So we decided that this could very quite easily run away with us and how we sort of address some of these issues and how we sort of guide ourselves to support our clients. Thanks a lot. Thanks. So we developed a model early on in the COVID lockdown period. So early April, we created our Rethink Model. And really that was designed to help to frame our thinking and the way that we would address specific issues and drive our conversations with clients and provide the best support that we could. So we established the model to be really simple. So we've got the react stage, which is where an organization is initially responding to the emergency, and that was lockdown procedures and various other activities around furloughing staff. We then moved into the resilience stage, which actually we're finding the vast majority of our clients are sitting in, and that's really where they're focusing on maintaining their operations and also sort of managing the supply chain and people and the other challenges. And then really the key point that we wanted to design around the framework was about the fact that there was going to be a new normal. And this was as much about sort of getting back into premises over the next sort of 6 to 12 months and operating while COVID is still with us, but also about looking further out towards the next sort of 12 to 24 months about what the new environment might be. And we're working very much on the basis that the further out that we could actually look, the greater support that we could actually provide to our clients in being able to anticipate some of the challenges which they're going to be exposed to. And the reason we called it Rethink is that we really wanted to reinforce that thinking process needs to happen now and as soon as possible, because obviously the decisions that companies are making now will obviously affect their ability to change later down the line. So in terms of framing, the model has helped us to improve our horizon scanning and also to provide clear and insightful guidance for our clients. And also we're working with economic bodies like Make UK and others to help to sort of get an understanding of what that new environment might look like and some of those challenges which are coming on. And we've framed in more depth, as you'll see on the right-hand side, some of those key areas typical to all businesses, and that's really about how we're framing our thinking. And you'll see on there we've got suppliers and customers and what that structure might look like. So overpinning this is the fact that we look at the 3 stages in terms of people and strategy and operations, risk, financials and regulation. And you'll see in the center there under risk, it's very much around the supply chain for the vast majority of our clients. And under the react stage, the primary focus has been around supply chain continuity and ensuring that we've been able to have continuous supply from our suppliers, but also making sure that that's timely and that we've matched that with demand. In terms of resilience, it's moving more into that supply chain optimization, and then realize that future state is really looking at how best for organizations to look at re-engineering resiliency within their supply chain. So what does this mean in detail? So this is really just playing back a lot of the issues and challenges that we're seeing across our client base on the conversations that we're having with them and the work that we're doing with them. And looking at this in terms of sort of raw materials all the way through to customers. So what we're finding is that, you know, a lot of businesses have been having challenges with around the ability to source key goods from suppliers, because whether that is in the UK or overseas, because a lot of the supplier base has actually been in lockdown themselves. They're also, in some cases, having higher demand pressures on key suppliers from their other customers. They may have been experiencing layoffs and furloughs and plant closures. And also, we're finding, particularly across the food manufacturing space, where they had issues very early on with attracting and retaining key talent and maintaining their production operations, primarily because they had a number of their workforce who were in lockdown and isolation themselves, so finding replacements to backfill. In terms of suppliers, we've seen a number of disruptions to supply chain, you know, whether that is because of shipping and access to ports, all the way through to driver availability, and also just, you know, with border controls with overseas supply chains. We've had supplier liquidity issues, and we've seen an increase in supplier defaults. And actually, we've spent quite a lot of our time over the last sort of 2 or 3 months working with clients around those particular areas and looking at supply chain and supplier viability, and making sure that suppliers are actually living up to what they're expected to deliver for us, and avoiding any sort of delivery delays and shortages. And also, a lot of our client base have been looking at identifying new suppliers, either for new products or as alternatives, working in that resilience sort of phase with maintaining their operations and looking at sort of higher risk locations and how they can make sure that they're getting an adequate supply coming through to their businesses. In terms of production, I've already mentioned about some staffing issues, but also about staff motivation, and making sure that staff are comfortable with coming into work, and that we've put in place the right sort of we're following government guidance and got the right mechanisms in place that staff can actually come in and work within our factories and our operations. Overcoming mandated shutdowns. Obviously, we're moving more out of those now. But also we found a rise where manufacturers were coming back into operations, and because they hadn't been able to maintain production assets, we're finding that some of the machinery wasn't working, and keeping up to date with repairs and maintenance. So a lot of activity around those areas in order to make sure that their equipment is fit for purpose. Moving onto the distribution side, obviously with employee safety, we've seen quite a few comments coming back from manufacturers who are actually quite surprised and have actually had to turn away a number of suppliers who have not been compliant with PPE requirements when they've come to deliver materials to site. And that's also caused an issue because they haven't been able to actually fulfill their deliveries. And I think that is an area of concern, which I think is about rolling down through the supply chain to make sure that suppliers are following government guidelines as well. We've had issues around scaling up capacity and storage, and also right-sizing inventory for shifts in demand. And obviously other challenges we have at the moment is around changes in trade policies and border delays and tariffs, as we've seen with shipping from country to country. And also we have the added challenge of an increase in protests and strikes, and the potential for that to increase over the coming weeks and months. We're also, at the same time as everything else which is going on around COVID and the impact that that's having on the supply chain, is around new environmental regulations that we need to ensure that we're compliant with. And not just on the environmental side, but also about making sure that we're compliant with existing regulations around things like payment practices. And on customers, we've obviously seen changes in demand. We've changed different routes where there's more online trading, and that's obviously having an impact on capacity and also the ability to satisfy customer demand on the time frames that are being set. Pricing considerations is obviously another matter which has become a challenge, particularly where we're seeing increases in discounting in order to stimulate customer demand within operations, and that will have a knock-on effect throughout the organisation. And also a lot of cases where sort of existing contracted customers, where they've been suffering from their own financial distress, and again having an impact on customer demand. And then also looking to acquire new customers and also retaining our existing customers has obviously been a challenge during this period, and is something to be mindful of over the next few months. So what sort of what are supply chains and businesses should be considering? So these are some of the things that we've been focusing on again through the conversations we've been having with our clients. We've seen some opportunities where some businesses have been pooling their resources from other sites, so that they haven't been holding. They've actually sort of kept some of the sites closed and then utilising the resources elsewhere where the demand is higher. Where they've been putting in controls to cover especially scarce resources and prioritising those to make sure that they have an adequate supply. Where they have looked at dual sourcing strategies and putting those in place. Some organisations have been looking about in-housing and in-sourcing supply into their businesses. Really so that they can maintain healthy reserves of materials. Many have been redesigning products and focusing on new markets to overcome shortages of raw materials. A big area for us that we've been spending quite a lot of time with some large organisations has been looking at supply chain risk. And assessing tier 1 suppliers as well as also tier 2 and tier 3 suppliers. The basis for this has been that in most cases businesses have been fairly comfortable with the financial viability of their tier 1 suppliers, but actually have less visibility of their tier 2 and tier 3 suppliers. And actually when they've been coming back on stream have been disappointed by not being able to source supplies and materials because actually their tier 1 suppliers in tier 2 and 3 have actually either been furloughed or are not operating or had their own particular challenges, and that's made the supply chain weakened. You need to reassess overseas supplier risks, also checking MRO suppliers to confirm key components, and that's really about making sure that we can maintain our machinery over a period of time. Focus on production scheduling agility and looking at ways in which we can adapt our production flows to make sure that they are adaptable for decreases and increases in demand. Looking at workforce productivity, and we've seen a number of organisations because of social distancing who have implemented 24/7 3-shift patterns in order to keep up with demand. And looking at the long-term viability of those sort of working patterns or making sure that we can adjust those as necessary. Looking at improving working capital efficiency, planning for different demand scenarios with your suppliers, so actually making sure that your communication channels are open and you're involving your key suppliers within your planning processes. Looking at in-housing and insuring. And that's particularly the case where we've seen supply chain from overseas entities which we have less control over. In terms of distribution, looking at alternative outbound logistics options and making sure that we secure that capacity, so that again we're not disappointed in when we need to be flexible, that actually our logistics suppliers are actually able to work alongside us to provide the service that we need when we need it. Looking at stock control parameters and making sure that we've reviewed any sort of inventory build-up strategy that we might have in place and whether that's still fit for purpose. And also we need to make sure that we're training the workforce to handle everyday risk, because one of the issues that we found is that most of the decisions and risk management has been done at a senior level, and that hasn't been necessarily well communicated down to the various levels of the workforce, and therefore that's actually created bottlenecks through production and supply chain because they just literally haven't had a good understanding of how to deal with particular situations. And really making sure that we communicate with our customers as well and really establish demand focus. So making sure that we're working alongside them, so we've got a really good understanding of what our customers actually are going to require from us over the next few months, so that we can work alongside them and they can work alongside us, so we know exactly what we're going to be doing over the next sort of 6 to 12 months. And also looking at your credit terms with customers as well, and making sure that we communicate those to customers to make sure that we're getting paid on a regular basis and we don't have any cash flow issues going forward. And then also developing any sort of customer segmentation strategy, so looking at our higher priority customers and making sure that we're focused on those, but also making sure that we have it using a tiered structure is making sure that we don't forget some of those other customers that may actually over the next few months become primary customers because of change in customer profiling. And then a really important part is about understanding our customer contract obligations, because going forward, what we don't want to do is get in a situation where we don't, where we default against what our customer contracts are actually set out for us to comply with. So I know there was a lot of information, and I'm sure the slides will be shared around. But there was a bit of a canter through really what we're seeing through our client base and the conversations we're having with clients.